So let me introduce the three speakers we have today. We have three speakers from different places and different, positions in what they do. We have Xiaowei Xu from the Institute of Fiscal Studies. She's a senior researcher there, and she specializes in the inequalities in labor market outcomes and health. And she will tell us, she will speak about the experience of UK and COVID inequality. And we also have the second speaker is Torsten Bell, who is from the Resolution Foundation. He's the chief executive there. And he will also give us his take on COVID and inequality in the UK, but with a particular focus on the lower and middle income households and families in the UK, because this is what the Resolution Foundation is concerned about. And the last speaker is Michael Stepner, who is an academic economist currently at the University of Toronto. He's been working in the team of Raj Chetty for some years, and they have developed this fantastic tool of collecting data and information about economic activity at a very granular level in the US. And he will be talking about the data they have collected regarding COVID and inequality using this toolkit. And he will tell us a little bit of some insights from what happens from the other side of the Atlantic in the US. So without further ado, I would like to pass on to our first speaker, Xiaowei. The floor is yours. We have 15 something minutes for each presentation, and then I will take over with a bit of discussion with each speaker among the speakers, and then we go to questions. Thank you.
Perfect, thanks, Chryssi. So let me just share my screen. Is that working? Is that okay?
Yep, that's fine.
Yeah, great. So I'm going to talk in quite broad terms about the effect of COVID-19 on different forms of inequality in the UK. And I think in the next presentation, Torsten will talk more specifically about the policies we've put in place and sort of specific distributional impacts. COVID-19 has really highlighted the inequalities that exist in our current system. So it's shown that some households were much better placed to weather the economic shock. And I think it's drawn attention to the disparities in the quality of housing, which means that some families have found it much easier to socially distance and self-isolate. It's also drawn attention to the state of the benefit system, which after 10 years of cuts was really poorly equipped to provide social insurance against this sort of shock. Which is why we've seen schemes like the job retention scheme essentially being drafted up from scratch. But as well as highlighting existing inequalities, things like sector shutdowns, widespread working from home, school closures, and also the health impacts of the pandemic itself have interacted with existing inequalities, in many cases deepening inequalities by income, age, gender, and ethnic groups. And finally, I think it's likely, especially as the pandemic drags on, that changes in preferences and attitudes and also technologies will lead to a longer run effect of the pandemic on inequality. So in this presentation, I'm going to focus on the second set of points around the interaction between COVID-19 and different forms of inequality. Towards the end, I'll also say a few things about the context in which we entered the current pandemic and say a few things about potential long-term legacies. So before talking about COVID-19 in particular, it's worth noting that in general, recessions tend to increase income inequality. So what the purple and green lines here show is that in the recessions of the late 80s and the late 70s, we saw a much larger drop in incomes among households towards the bottom of the income distribution than households towards the top. Now, the exception here is the 2008 recession, but that's due to the very specific nature of the 2008 recession, which had a large effect on earnings, but very little effect on employment. And now we're already seeing unemployment start to rise, so it's much more likely that the current recession will follow the pattern of previous recessions. But as well as the general impact of recessions on inequality, the specific nature of the COVID-19 shock is likely to further widen disparities. So for example, we know that social distancing and widespread working from home have had a much larger effect on workers who were low paid to begin with. So the chart on the left here shows that before the pandemic hit, the share of high earners So the high earners were much more likely to work in sectors that remained operational during the initial lockdown than low workers. And if you combine this with information on who can work from home based on the jobs that they're in, you see an even steeper gradient. So based on the pre-pandemic data, we know that more than 70% of those in the top 10th of the earnings distribution worked in a sector that was not shut down and worked in a job that could be done from home, compared to less than 20% of those in the bottom 10th of the income distribution, of the earnings distribution. And so unsurprisingly, what we've seen as the pandemic has unfolded is that those on low earnings have been much more likely to have been furloughed, laid off, and seen their hours reduced than those on higher earnings. It's worth noting, though, that when we look at the effects on incomes rather than just on earnings, we see that the effects are much more evenly spread. So that suggests that the tax and benefit system has been pulling some weight in smoothing effects across households. And perhaps Torsten will talk more to this later. Still, we know that poorer households had very little leeway to adjust their spending in the face of shocks. So this chart shows spending on different types of goods across poorer and richer households before the pandemic hit. And what we see here is that for the poorest fifth of households, the majority of their spending went on necessities like groceries, utilities, and housing. And so unsurprisingly, since the pandemic, IFS analysis using bank account data has shown a sharp increase in missed bill payments in terms of utilities and council tax among poorer households. Now, at the other end of the spectrum, we see here that before the pandemic hit, a third of the spending of the richest fifth of households went on things like holidays, restaurants, and transport, which were simply forbidden for quite a long period of time, and for which demand is still much lower than before. And what that means is that richer households were essentially forced to save during the pandemic. And again, IFS analysis using bank account data shows that the savings of richer households increased during the course of the pandemic. Another group that's been really hard hit is young people. So this chart shows that young people aged 16 to 24 were 3 times more likely to have been furloughed in July and 6 times more likely to have been laid off in June than older workers. This is likely to do with the types of jobs that young people work in, so they're disproportionately likely to work in sectors like retail, hospitality, and leisure that have been very hard hit by the pandemic. And of course, it's not just young people who were currently in the labour market who were hit by the COVID-19 shock. It's also the cohort of young people who are entering the labour market. And given the massive fall in vacancies we've seen across the board, these young people are likely to have a very hard time as well. So far I've talked about the economic impact, but we know that the health impacts of the pandemic have not been evenly spread either. So this chart shows the rate of death from COVID-19 across different local areas ranked by their level of deprivation. And what we see here is that in the most deprived local areas, adjusting for the age composition of these areas, people were more than twice as likely to die of COVID-19 than those in the least deprived local areas. Now, of course, in general, mortality rates are higher in more deprived areas. But what I want you to see here is that the gradient is even steeper for COVID-19 deaths than deaths overall. This is likely to reflect a number of factors. So, for example, more deprived people are more likely to have comorbidities that make them more vulnerable to the virus. They're more likely to work in occupations that expose them to the virus. And they're also more likely to live in cramped housing, less likely to have access to gardens, which again exposes them more to COVID-19. COVID-19 deaths have also been concentrated among certain ethnic groups. So these charts show for men and women how likely certain ethnic groups are to die of COVID-19 compared to the white population. So a value of 1 here would indicate that that ethnic group is equally likely to die of COVID-19, the white person. And what we see here actually is adjusting for the age composition of these groups, Black African men are more than 4 times more likely to die of COVID-19 than white men, and Bangladeshi men are 3.5 times more likely to die of COVID-19. The differences between women are smaller, but really still very stark. Now, this is using analysis from the ONS, and they show that a large part of these differences can be explained by differences in where people live, their socioeconomic conditions, and also differences in their self-reported health. But even controlling for these basic demographics, we see really large differences between ethnic groups. So in particular, Black African men and women are around twice as likely to die of COVID-19 than white men and women, controlling for broad socio-demographic factors. Now, again, this is likely to reflect the specific factors that put you at risk to COVID-19 that I talked about earlier. In particular, the fact that Black Africans are disproportionately likely to work as key workers, and in particular as social carers, among whom we know that there's been very high mortality rates. COVID-19 has also led to a large deterioration in mental health, and that impact has also been unevenly spread in a way that exacerbates pre-existing inequalities. So here we're looking at a broad measure of mental health called the GHQ, where a higher GHQ score indicates worse levels of mental health. And the bars here represent our best estimate of what GHQ scores would have looked like in April 2020 on average across these groups in the absence of COVID-19. So this is based on individual level modeling using several years of panel data before the pandemic. And what we see in this counterfactual is that young women in general would have had worse levels of mental health than, say, older men. But when we look at the actual data on mental health in April 2020, we see that younger people, and especially younger women, saw the largest deteriorations in mental health still. So the mental health deterioration was largest among groups that already had poor levels of mental health going into the pandemic. The last point I wanted to make was that school closures are likely to have exacerbated educational inequalities as well. So this data, which comes from an IFS survey, shows that richer kids in state schools are much more likely to have had personalized online tuition during the period of the lockdown than poorer kids in state schools. These are all for state schools. When we add private schools into the mix, the inequalities are even larger. So we see here that kids in private schools, nearly 80% of them received online classes during lockdown, whereas only about 40% of the poorest third of students in state schools had access to online classes. So just to say a couple of things about the context in which we enter the pandemic before wrapping up, because I think that's important in terms of understanding the implications of the pandemic. The first thing to note is that we did not enter the pandemic from a position of strength. So we'd seen a decade of earnings stagnation since the financial crisis. Median earnings had just about recovered to their pre-2008 levels at the time COVID-19 hit. We've also seen a rise in earnings inequality since the 1990s, although up until recently that had been offset by an increase in the generosity of in-work benefits, in particular tax credits, as well as rising unemployment among poorer households. Both things, however, have come to an end. We've seen a general erosion in social insurance provided by the state. So I mentioned that we've just gone through a decade of cuts to working age benefits since 2010, but this is really part of a much longer trend. So when we look at the value of out-of-work benefits, we see that their value has fallen relative to earnings since at least the 1970s. And all this means that the UK has one of the lowest replacement rates among developed countries. So that's to say that if you lose your job in the UK, you would lose a larger share of your income than if you lived in comparable developed countries. And finally, the state was not very well equipped to insure against economic shocks, but people also had very little scope to privately insure against shocks. So coming into the pandemic, there was a very large fraction of households who had low savings and high debt. This was especially true among poorer households, but not limited to poorer households. So where would we go from here? What about the longer term legacy on inequality? Well, as I've said, the pandemic has exacerbated existing inequalities along a number of dimensions. And I think it's likely that as support schemes are unwound, these economic disparities might grow even further. But just to end on a more optimistic note, I think it's possible that certain developments during the course of the pandemic might also lead to positive changes going forward, perhaps optimistically. So it's possible that as more people come into contact with the welfare state, people who didn't expect to fall back on benefits before, perhaps this might change attitudes towards the welfare state, and maybe in particular draw attention to the need for social insurance, as well as just providing a very basic standard of living. Certainly at the start of the pandemic, things like clap for carers really emphasized the status of key workers, and perhaps that might lead to a better position for them going forward. And whilst in the initial lockdown, due to school closures, gender inequality, especially among parents, really widened, it's possible that the broader shift to remote working might improve gender inequality going forward. Finally, it's possible that the debate over the level at which decisions are taking place, in terms of local lockdowns, for example, or the track and trace system, might lead to more decentralization of policymaking, which may then rebalance regional inequalities. But I guess the key thing here is the policies that are put in place during the pandemic in future months. And with that, I guess Torsten will talk more about policy.
Thank you very much, Xiaowei, for this. I will now pass on to Torsten for the second talk, which will be more focusing still in the UK, thinking about UK data, but focusing more on the middle and lower income families and households. Thank you very much.
Great, thank you very much, Chryssi, and that's a great presentation to follow up. I'll attempt to make the IT work so you can see some slides. Here we go. So I'm going to build on that previous presentation, but focus more narrowly and less impressively on the breadth of what was covered and focus on the economic side of the impacts. And that isn't because I think they're more important than the other impacts, it's just what we work on. So that's what you're going to get today. I think in particular, I want to bring out how some of those impacts of the inequality on the labour market interact with household incomes and interact with the policy response, and then let's touch on where we go from here with a bit of detailed analysis of the policy proposals that have been set out in recent weeks by the government. And apologies to those watching from outside the UK, this is UK focused, although the analysis of some of the trends, particularly the sectoral trends, are common across countries. So let's get in. So look, the big picture is that compared to other economic crises, this is a classic and very, very large labour market shock. And it is one that is very focused on two particular groups, young workers and lower earning workers. Those are the defining features of what we've seen so far, in particular in the heat of the crisis as when we were most locked down, but actually those are also the groups that we're going to be seeing losing jobs most significantly in the weeks ahead. So then the question is then, I'm not going to spend ages on that because I think you've had that well covered in the previous presentation. I think the issue to dwell on is then, what does that mean for inequality? And it is not straightforward to say because it is focused on low earners that the crisis has been bad for low income families. So I'm going to touch on four areas about how this interaction, how we need to think through this interaction to understand what it actually means to different parts of the income distribution. The first is to move from the earning distribution to the household level income distribution. The second is to then say, how does policy interact with those shocks from the labour market? The third is to remind us that household budgets are about what goes out as well as what comes in. And then lastly, the balance sheets really matter. If I had time, I would also go into a bit more detail on history, because humans, like everybody, are path dependent. And the point that Xiaowei makes about what has happened to household incomes over the last, actually for the lower income households over the last kind of 15, 20 years, not just the last 10, is the really important driver of outcomes during this crisis. But we haven't got time, so you're going to miss out there. Right, now, how do we get from workers to the household income level? Well, as we've said before, lower earners are much more likely to have been furloughed and to have lost their jobs in this crisis. Focus on the gradients here, lowest earners at the top, highest earners at the bottom. The individual numbers change month to month and based on different survey metrics. This is from one in May, because I want to be consistent with some later data at the household level I want to show you. But if I showed you data from June, the gradient would look very much the same. So the point is, you're much more likely to be furloughed if you are low earning. That is almost all, although not quite, but almost all driven by the sectoral nature of this crisis. The shutdown in the hospitality, retail and leisure sectors has been so much more severe in terms of lower output than in other sectors of our economy. 77% of hospitality workers furloughed. That's 10 times the furlough rate in the finance sector. Even though we call the financial crisis, it was never that sectorally focused on the finance sector. This crisis is very sectorally differentiated, and that is why low earners and young people who work in those sectors are being hardest hit. So low earners hardest hit. So are workers in the lowest income households. So here I'm moving to a household income level distribution and saying, if you were a worker in the lowest income 20% of the population, 1 in 5 of you were furloughed and 8% had already lost their jobs by May. Okay, so that fits the same pattern, although you'll notice the gradient here is not as steep as it is just looking at the earning distribution. But if we then turn to who has seen household income falls across the household income distribution, again here, lowest income at the top, highest income at the bottom, you can see actually it's much more evenly spread. We are not seeing on income falls an inequality increasing, significantly inequality increasing initial impact of this crisis, despite low earners being much more likely to be affected. And there are 2 big reasons for that. There are lots of small ones, but there are 2 big reasons I'm going to dwell on here. The first one is because this is a labour market shock and low income households have fewer workers in them. So half of the adults in the lowest income 20% of households aren't working. So even if we had very low earners focused impact of the shock, who are disproportionately in the lowest income groups, because lots of people in the poorest households aren't working at all, the share of income hits coming from the labour market are smaller for the poorest households. Another important way to think about this is, although low earners are the ones bearing the pain, a lot of those low earners are in higher income households because basically they have a higher earning partner in their household. So the lack of labour market damage to the poorest households is a really important feature of why we are not seeing the transition from low earners hardest hit just simplistically playing into a low income households hit. But it is not the only one. So the second issue is what role does policy play in this? And it's clearly very complicated, and it's going to take us years to disentangle this properly. So I'm just going to provide some elements of the package. The first is to just say the scale of the policy response was very, very large. The amount of social insurance going on, not necessarily through the social security system, is of a like that we've never seen in Britain before. The attempt to insure people against a crisis they couldn't have privately insured against was very large, particularly for households, but actually also for firms to a significant extent. So the job retention scheme, the furlough scheme, is the single biggest element of that, costing over £50 billion. This is showing you the time series of how many people were on that. So at the peak of the scheme, which remember this scheme pays 80% of your previous earnings if you cannot work during when your company is either shut down or operating below capacity if you were previously employed. So this is all about insider protection here. This is not about income protection for people of all kinds. The peak was 8.9 million people furloughed at the beginning of May. And even today, or even at the end of September, when we are a month away from the scheme being wound up completely, there were 2 million households, workers, still on the scheme based on survey evidence. We don't have the admin data yet. And that is hugely disproportionately made up of hospitality workers, about 600,000 of them, and leisure sector workers. Think of gyms, think of arts venues and the like. So that social insurance coming through there meant that the labour market hit I was showing you on the first chart about low earners was being protected. The amount of income fall you actually had was a lot less. To put it bluntly, you kept 80% of your labour market income rather than losing all of it if you couldn't work at all. The second thing that is much more important for the bottom part of the income distribution for lower middle income families is that we saw a very significant increase in benefits right at the beginning of this crisis, £9 billion worth of immediate increase in in benefit payments. To keep it simple, the way to think about the most understandable part of that package is that the government increased the annual amount that went to people on benefits by £1,000. This is for in-work and out-of-work benefit claimants. Increased it by £1,000 per household. There are other changes as well that are significant, but that is by far the biggest one. The effect of that, remember, going to people who were losing their jobs during this crisis or reliant on benefits, but also those who hadn't had their incomes affected by the crisis at all, was to significantly aid the incomes of the poorer part of the distribution. So this chart is showing you what the change in income, as we estimated it in May, i.e. the peak of the lockdown, across the income distribution, taking the pensioners out, so poorest households on the left, richest households on the right, with and without that benefit increase happening. And what it's broadly saying is, remember, everything I'm showing you here is about averages. There are loads of bigger losers by individual households and loads of winners. This is all about averages, which is always a dangerous thing for anyone who spends their time on stats. There's loads of people doing much worse than this chart shows in the real world. But on averages, it shows you that the poorer households had their income broadly protected, i.e. they were the same in May as they were in the previous year because of that benefit increase. Had that benefit increase not happened, they would have been the biggest losers by far. So it changed slightly the shape of the distribution from being very heavily regressive to being broadly flat / slightly marginally progressive over that phase. Now, that's just the initial phase of the crisis, but that is a very big impact of policy on how the crisis would affect. As I say, a lot of that includes income increases for those that already were out of work, and income falls for those that were previously working at the bottom. I think that's really important to understand the distinction. So policy makes a big difference, is a clear lesson from that. Right. Then, as I said, household budgets are about income coming in and they're about spending going out. And both really matter for how families' financial situation measures up. So this chart is showing you, again, the same broad picture, which is highest income at the bottom, lowest income families at the top. And let's just focus, to keep this simple, on the blue bars on the right-hand side, and in particular, the very dark blue and the middle blue, or whatever that color is, where what I'm really saying is that the higher income households have been twice as many higher income households have seen their spending fall by more than 10% during the crisis as compared to lower income households. And this is survey data that's reinforcing the point that Xiaowei was making in her slide about in principle, what do we know about high and lower income households? Higher income households spend their money, yes, on non-essentials, but what's really important is they spend their money on face-to-face services, eating out, holidays. The very sectors we are shutting down are the ones where the propensity to consume rises very fast as you become a higher income household. So as we shut those sectors down, high income groups are seeing their spending fall very significantly. In fact, their spending falling, and then, as I'm going to come on to in a second, being able to save lots of money, is exactly the flip side of low earners losing their jobs. High income people spend their money on face-to-face services where low earners work. That's basically what's happening in this crisis. So this is showing to you spending has gone down, and what that has gone down significantly for high income households. And what that has meant is that if we turn to this chart, that although the income hit was fairly evenly shared across the income distribution, the number of households actually finding their situation getting worse as they manage their family budgets is much worse for low income households, because they are not seeing the same spending fall. So if you are a low income household and you have seen your income fall, you are not able to reduce your spending to cope with that. Whereas if you're a high income household that saw their income fall, you were much better placed to cope because you just cut your spending, because that's what everyone was doing anyway. So we see, 36% of low income households finding their financial position worsening during the crisis, whereas actually high income households were as likely to see their financial budgeting improve as they were to see it get worse during the crisis, despite income hits being evenly spread across the distribution. Now, that is the flip side of the thing I'm going to end on in terms of this section, which is balance sheets, which is, you'll all have seen charts like this. The savings ratio has gone through the roof. In Britain, we don't do any saving anyway. We definitely don't save 29% of our income generally, but that is what we did in the second quarter of this year. before everyone gets carried away and says that means it's all hunky-dory, because we've all got strengthened balance sheets, so it'll all be fine, I want to show you that it really depends who you are about whether you've done that saving. So the saving is being done by those same richer households who had seen those consumption falls that I showed you in the previous section. So this chart, focusing on the green bars, and again, let's focus on the richest households, is seeing big savings increases for 34% of the higher income population, despite it being a time when incomes were falling. Whereas if you go to the poorest households, they were not seeing they were not seeing savings increasing at anything like that same rate. And it goes without saying, obviously the highest income households were the ones saving in the first place. So the people already with savings saved a lot more, and the people who weren't saving didn't manage to increase savings as much. The flip side is that lower income households who are seeing those budget strains because they couldn't cut their expenditure as their income fell are the ones that turned to debt. This is showing you how many turned to consumer debt during the peak of the crisis. Again, heavy gradient from the lowest. And again, it's really the bottom two quartiles, because the second quintile, where you've got a lot of earners, but they can't cut their spending as much. So it's not the very poorest necessarily, because if the very poorest weren't working, they've had the benefits increase and no labour market shock. Whereas the second quintile has had a labour market shock as well as the other problems, and has more essential spending. So that is broadly where I think we are, which is it is not affecting inequality in the way economists tend to focus on inequality, which is what does it do to household incomes yet. But it is being felt much harder for lower income households because of their inability to cut spending in the same way as higher income households. And then it's going to briefly reflect on the policy package going forward and then wrap up. So, I mean, this is old news to all of you, I'm sure, but we're moving in Britain, not in the US, but in Britain, we're moving into the job loss phase of this crisis. The furlough scheme froze our labour market basically in stasis back in May. As we have unfrozen the furlough scheme, we are revealing the damage to the labour market, and that is then feeding into unemployment. You saw in the unemployment stats last week, the biggest increase since in 10 years in unemployment. This is just showing you furlough rates by sector and saying at the end of July, 4 in 5 leisure and hospitality workers were still furloughed. That was still 4 in 10. That was still 3 in 10 during September. So that is where the pain is coming, and that's why the job losses are going to be focused amongst low earners as this autumn proceeds. The government's attempt to set policy is in danger of making significant mistakes in this regard, and this chart is trying to show you 2 of them. So the government has set a policy to phase out its furlough scheme in the hope that it was also able to reopen the economy as the virus was got under control. And until even halfway through September, government policy was very much set on that single scenario transpiring. Now, obviously by then we already knew that wasn't happening in France and Spain, but obviously, as always, we thought we were exceptional, just like the Scots did as well, and just like bits of different parts of the country now think they are exceptional. One thing we learn is that humans are never exceptional when it comes to pandemics. We all make the same mistakes over and over again, which is what we're now doing. So they've set policy on the hope that we are phasing out the crisis. We are not. So there's 2 big problems to flag. The first is that for firms that are being legally required to close, they are allowing them to continue to use the furlough scheme, albeit at a lower rate of replacement. So that is showing you the difference between the top 2 bars here. Under the old job retention scheme, the original furlough scheme, the worker got 80% of their wages, all of it paid by the state. Under the new furlough scheme, which they don't want to call a furlough scheme because that would be a U-turn, but is a furlough scheme, it is 2/3 of their wages they get paid for by the state. But you are only eligible for that if your business has been ordered to close by law. And that is a tiny, tiny minority of businesses. So across the country, it's basically just nightclubs. And in the lockdown areas, it's nightclubs plus bars and restaurants that don't serve food, and gyms in some parts of the country, plus betting shops. So these are small areas. If your business is closing because there's a pandemic on and you haven't got any business, you are not eligible for this scheme. Okay, so eligibility is the key problem. Then for all businesses that are theoretically eligible for the other part of the current job support scheme, the bottom line here, The challenge is not whether you're eligible or not, it is whether your firm, your employer, has any interest in using this scheme. And that is because the difference is you have to be working at least a third of your previous hours. So it's not a furlough scheme in the usual sense of no work at all. But much more importantly, the employer is required to pay 22% of the 66% of the wages for the period you are not working. So the employer must pay for the period you are not working, unlike in Germany and everyone else that does a version of these short hour working schemes. And as a result, it's more expensive to employ multiple people on this scheme than it is just to employ one person and to fire the other people. So as a result, on this scheme, employers are being asked to pay too much and therefore will just choose to lay off their staff. The result of that is that we will have to be reliant on universal credit rather than on these furlough schemes to provide the income support in the next phase, the unemployment phase of this crisis. And this chart, without going into details, is just showing you replacement rates across the earnings distribution, earners on the lower earners on the left, higher earners on the right, and just makes the point that whichever version of the furlough schemes I was showing you on the previous chart you want to compare it to, universal credit sees about half the level of income replacement as you saw under the furlough scheme. So we're about to see very big income losses as people move on to universal credit. That is particularly a problem because the government is intending to reduce the level of universal credit by reversing that £1,000 increase that they introduced at the beginning of the crisis in April next year. And the impact of that will be to reduce the incomes of around 6 million households by £1,000 a year. This will knock the disposable incomes of lower middle income households down by a staggering 7% at a time when unemployment will be at a generational high. This is a very, very, very bad idea. Policy did a brilliant job in the initial phase of the crisis and is currently calibrated to actually be causing a large amount of the problem in the next phase of the crisis. So then just to wrap up, rather than go on any further, the crisis so far hasn't damaged inequality as economists generally think about it, household income inequality. But it has put a lot more strain on lower income households' budgets. And that has been very real. And that is why you are seeing food bank usage going up across the country, expected to rise by over 60% this winter compared to last winter. Policy has done a very, very good job of ensuring incomes, with the exception of how it's dealt with the self-employed, through the first phase of this crisis. And it's done a particularly good job for lower income households on average, But the real problem is that policy is now moving from being part of the answer to being part of the problem, because it is both increasing the shakeout into unemployment and reducing the level of income support people will receive in that unemployment. So Chryssi, back to you.
Thank you for a fantastic overview of important facts and data there. I will now pass on to Michael that will give us his take and some very precious data that comes from the US. And also not only from a different country, but also with different methodology. If I may highlight here is that the first two presentations were based on survey data mostly. Here we'll see something completely different. So to you, Michael, thank you.
Thank you, Chryssi. So one thing that COVID has really highlighted is how interconnected we all are around the world and how we're all experiencing similar things despite very different policy environments. And as I sit here in Canada presenting to a largely UK audience about the experience in the United States, one thing that I've really enjoyed about the first two presentations is how much the struggles that are being described that the UK is facing are really going to resonate with the presentation I'm going to give you about the US. And so this talk is work that I've done jointly with Raj Chetty at Harvard, Nathan Hendren at Harvard, and John Friedman at Brown, where we've built a new public database of real-time economic data at a very granular level using private sector data. And we're going to use that database to show you what's happening in the United States with COVID-19. So really our motivation is the same as pretty much everyone's these days. We want to understand what's going on and how COVID-19 has affected the American economy. And as Torsten was much as Torsten was getting at, what policies can best mitigate its impacts going forward? And for pretty much a century now, macroeconomic policy is really based on the types of large-scale surveys of households and businesses that you've seen all of the charts so far have really drawn on. And these statistics are absolutely vital. They're what feed into GDP and unemployment calculations, but they have two key limitations. The first is that they're often available only at low frequencies with a significant lag. So in the United States, for consumption data, we wait 12 to 18 months in order to find out what people were consuming last year. For GDP, we wait until sometime in the next quarter, a lag of over a month. The other limitation is that because of just the number of people who answer a survey, these data can't be disaggregated to examine variation at a small area or across subgroups. And so what we do in this project is we've built a publicly available economic tracker that draws on data from private sector companies in order to measure daily economic activity at the level of a zip code, which is just a handful of thousands of people, or by income group or by industry. And we're going to use that data to provide two types of analysis about the COVID-19 pandemic. Really, with just 15 minutes, I'm going to try to draw out the highlights of both Xiaowei, both presentations this morning, but for the US. I'm going to talk about the mechanisms of how COVID-19 led to unprecedented job losses, and then talk about the policy responses and look at the effects of the policies that have been acted to date in the United States. And so this project really fits into a growing number of papers that are using transaction data to analyze economic activity. But really the benefit of releasing these public statistics based on private sector data, I think, is that it makes this data that is typically being analyzed by small research teams who have signed like particular contracts available to everyone. So there's no need for everyone to write a specific contract. The challenge there is there's a tension between the research value of the data, where we want things that are as narrow and precise as possible to really illuminate what's going on, versus the protection of privacy, which is that these companies don't want the details of their clients being shared publicly. And so I really think of this presentation as sort of a model, maybe a pilot project that can illustrate how this type of work can be done, not just in the United States, but more broadly. And so the data we draw on, really this presentation, I'm going to start by talking about the data, talk to you about the impact, and then look at the stabilization policies. The data we draw on is going to come from a number of companies. And so there's some household names like MasterCard in there, which is processing 30% of card transactions in the United States. Intuit is a major public company, as well as some private companies that really gather a lot of data. So Affinity Solutions is a company that has about 10% of card spending in the US. Burning Glass is a company that's scraping nearly 100% of job postings that are posted online. So we're going to gather and process all of this data, and then we release it publicly on a website called tracktherecovery.org. And so all of the results that I'm going to show you in this talk are based on statistics that you can go and you can download yourself online. And so I'm going to start by really the motivation starts from the massive GDP losses. And here we're looking at the change from Q1 to Q2 of 2020. And if you disaggregate that, most of that GDP loss is coming from the massive decline in personal consumption expenditure. And much of that can be measured using card spending. And so taking these national statistics, we're now going to zoom in on card spending and give you a very granular picture of what's going on. And it starts with disaggregating by income. And so if we look at the highest income quartile, spending fell by 40% initially, but is now down by about 10%. And so you have over $3 billion daily drop in spending at the peak, at the trough of the crisis. And for low-income households, the drop was somewhat smaller on a relative basis, a 30% drop, but importantly, much smaller on an absolute basis, so a $1 billion daily drop in spending. And today, that spending drop has been nearly eliminated by the increases in benefits. And so this, in spending terms, this recession is really driven by the behavior of high-income households. The top quartile accounts for more than half of the aggregate spending reduction throughout the period, and today it's really almost all of the spending reduction. And so the next question is to figure out, why did spending fall? And is it driven by a reduction in purchasing power or expected future income, or is it driven by these health concerns and a fear of catching COVID-19? And we're going to be able to answer that by disaggregating by sector. And so if you look at where people's spending has declined, 2/3 of that spending decline has been in face-to-face services. And if you think about what people were spending on before, only 1/3 of that spending was on face-to-face services. So there's really this massive decline in the precise sectors where people face a risk of catching COVID. And if you really zoom in even more detail, spending is virtually unchanged on the types of luxury goods that, if people really were responding to a reduction in purchasing power, you would expect them to spend less on landscaping and at-home swimming pool installations. But that has been unchanged through the crisis. For rich people, people can come and install that and work outside your home without any risk of you catching COVID while you sit inside. But restaurants, airlines, barbers, and beauty shops have seen massive reductions in revenue as people have stayed at home and avoided them. So this is a very different crisis from past recessions. In past recessions, most of the spending reduction has been on durables, whereas today, much of the spending reduction has been on services, which are typically quite resilient in the face of recessions. And so moving from spending, we then ask, okay, well, how does this flow in to small business revenues? And in particular, thinking about the fact that different businesses are differentially exposed to the spending of rich people and are differentially concentrated in services. So thinking about small businesses in particular, small businesses tend to be concentrated in the service sector, and many small businesses are reliant on the spending of high-income people. And so if we zoom in at the zip code level in New York City, you can really see this playing out, where the largest declines in revenues are in the financial district in Midtown Manhattan, where high-income people are not going to work and are not spending their money at the local restaurants and beauty parlors. If you look, say, uptown, I know this example might be more immediately salient to Americans who can just recognize the geography of New York City. But if you go up from this central red zone and up to the upper right, then you're entering the Bronx, a lower income neighborhood of New York. And of course, spending there is, business revenue is down there too by about 25%, but much less so. The drop is less than half as large in the lower income areas of New York City. And that's not just a pattern in New York City, that's happening throughout the United States. So if you look from the most affluent areas, where you have the highest median rents, to the least affluent areas, you have an almost doubling of small business revenue losses. And that is concentrated in particular sectors. So if you look in particular at the finance and professional services sectors that don't rely on face-to-face services, their revenue declines are not sensitive to the local affluent. So really, some businesses are being hit much harder than others. And those businesses are the ones that are focused on serving affluent consumers and those that are providing face-to-face services. And so these business losses, we then ask, well, how are businesses responding to these losses in revenues? And how is that translating to employment losses? And if you look at the trough of the crisis, everyone, regardless of whether you're in the bottom of the income distribution or the top of the income distribution, there was much less furlough behavior in the United States than in the UK, because the government decided to expand unemployment insurance benefits rather than provide a furlough benefit. And so at the trough, everyone had lost their jobs. You were much more likely to have lost your job if you were in the bottom wage quartile than the top. As the recovery has unfolded, what you've seen is a complete recovery for people at the top of the income distribution. They've either returned to the office or been able to just transition to at-home work. Whereas for people at the bottom of the income distribution, the recovery started to occur and then completely stagnated. So if you look at the end of August, employment was still down by 20% at the bottom of the income distribution. Based on it takes a little, even with private sector data, it takes a while for people's payroll to process. But if we look at the most recent hourly data and biweekly payrolls, you can see this trend just continues through the end of September, where there's just a total stagnation in employment for low income folks. And so that happens throughout the entire country, where if you look at changes in employment and the bottom wage quartile, it's really just concentrated losses in the most affluent areas of the country. And so one other important fact is that it's more difficult for them to find jobs. So here we're looking at job postings for low education workers, where in precisely those areas where they've been most likely to lose their jobs, it's also most difficult for them to find a job because job postings are down by 40%. So you have extremely tight labor markets in the most affluent areas of the country in the United States. And so one important but perhaps speculative question is, like, will employment of low wage workers start to revert to baseline as spending recovers? And of course, this is a question about the future, but I think we can start to provide some preliminary evidence on this. If you look at trends in consumer spending has recovered to a large extent. So by the end of July, consumer spending was down 7%. Employment for low-income households was down 15%. And employment for high-income households is down only 1%. And so what this suggests is that there's a shift in the production function, a shift in how businesses are providing people with the goods and services that they're spending money on. And businesses have shifted toward less employment of low-wage workers. You might think, is this entirely driven by sectoral shifts? And so if we reweight the bottom wage quartile to match the sectoral and geographic distribution of high-income workers, you still see this massive drop. And so really, for us, this is cause for concern that you might have a really stagnant sort of jobless recovery, where the spending recovers, but recovery does not pick up for employment of low-wage workers. Even in retail trade, this is perhaps even more dramatic, where you see spending is up for retail trade, but has shifted largely to online businesses and toward Amazon and to the largest retailers like Walmart in the United States. And so you see unchanged employment for high-income workers in this area, but massive losses for low-income workers. And so putting this together, there's real signs of a jobless recovery in this recession that we plan to continue to track. And so I know I need to wrap up quickly. So I want to ask, how can we mitigate these employment impacts? And I'm going to briefly go through three policies that were very important in the US response. And so looking at throughout the rest of the talk, I'm going to look at three policies: state-ordered reopenings of the economy, direct stimulus payments to households, and loans to small businesses. So in the United States, state-ordered reopenings have been very salient, where governors of individual states have said, time to shut down the economy, and then a handful of weeks later said, everything is fine, it's time to reopen and spend your money at businesses. And if you look at what's happened here in just a case study, New Mexico and Colorado are bordering states that closed at around the same time. You can notice that spending had already declined before anyone had been told by their local governor, you have to stay home. So people were really responding to local prevalence of COVID, but they decided to reopen at quite different points, about 2 weeks apart. We see that there's virtually no spike in spending at the time the governor says it's safe to go out and spend your money. So really, it seems that people are responding to this circumstances on the ground, and that simply announcing reopening policies is not going to be sufficient to stimulate the economy. Really, the local context and the local prevalence of the virus is key to people's behavior. This is just 2 states. If you combine them all, you see once again a very similar pattern across states that are reopening at different times. At most, the effect is about a 2 percentage point change in consumer spending. Similarly, in employment, about a 2 percentage point change in employment. So it seems like just words are not enough to reopen the economy and stimulate spending. Now, how about stimulus payments? So the US government in the CARES Act made direct stimulus payments to about 160 million people. These were typically $1,200 checks, so $1,200 checks that arrived. Almost all of them were deposited into people's bank accounts on April 15th. And you can see this in the spending data. Here I've put a dashed line on April 15th, and you can see spending spiked by 20 percentage points for the lowest income households. High income households were far more likely to save that money. Spending spiked by only about 6 percentage points. And importantly, when thinking about a macroeconomic stimulus, we need to not only know whether people spent, but what they spent their money on. And if you look, these bottom income households had about a 26 percentage point increase. Highest income households had a 9 percentage point increase, but that money went to durable goods. So there was a 21 percentage point increase in spending on durable goods and a very small, almost insignificant effect on in-person services. So this stimulus spending did help people weather the storm, but it didn't go to those businesses. It wasn't a traditional like Keynesian stimulus that goes to the businesses that are suffering. And so really, if you look at these revenue changes for small businesses continue to have much lower revenue and much lower employment. And so finally, if we think about loans to small businesses, the CARES Act also provided $500 billion in loans to small businesses. This was called the Paycheck Protection Program because the goal was to keep people on payroll, actually incentivize these small businesses to hold people on payroll, and the loans were forgivable if these businesses didn't reduce their payroll. And so if we look at the businesses that were eligible with fewer than 500 employees versus those that were ineligible, this had at most about a 3 percentage point impact on on employment. And so the cost per job saved was about $300,000, about $163,000 at the lower bound of the 95% confidence interval. Whereas these jobs that were being saved pay about $40,000 a year, typically. And so this was, in terms of bang for your buck, in terms of saving, providing fiscal stimulus and saving people's jobs, this was a very expensive way to keep people on payroll. Most of this money did not end up in the pockets of workers. And if you ask, why did that happen? It seems bizarre given the design of the program. What we see is that there was very high take-up among precisely those firms and sectors where they were unlikely to be shutting down and laying off their workers in the first place. So professional and scientific services, firms in the professional and scientific services sectors were the most likely to take up these loans and also were really doing just fine for the most part. Whereas firms in the food services sector, which had the largest losses, they weren't on the margin of shutting down. They were already shutting down. And so the fact that if they kept their workers, they could get these loans forgiven did not incentivize them to stay open, was not adequate to keep. These money did not end up in the pockets of workers who were just bound to be shut down based on the effects of the virus. And so turning just for a minute to the long-term impacts, I think we really get at something that Torsten was mentioning in his talk, which is if we think about how these, here I'm looking at the daily bank balances of low-income workers who received or did not receive unemployment insurance benefits. In the United States, unemployment insurance benefits actually exceeded a 100% replacement rate throughout the period in between these dashed lines, where the US government expanded unemployment insurance benefits. And you see that actually people who were on unemployment insurance benefits were saving more money than they ever had in the past, and were actually doing better than people who were at work. These expanded benefits expired in the second dashed line at the end of July. And these people have been spending down their savings to the point where now, just at the beginning of October, they have returned to the level of distress among people who were not receiving UI and are actually similar to where they were at the beginning of the crisis and are continuing to trend downward. So we're at this sort of inflection point where government benefits have expired. They haven't been renewed. Politicians are continuing to negotiate over what to renew them with. But in the meantime, low-income households in the United States who have been protected so far are entering a period of real financial distress. And what happens to them going forward is going to depend on what the government does in terms of renewing benefits or creating new benefits. Because right now, that financial distress is just growing over time. The last, thinking even further forward on inequality, I want to turn to data on educational progress from an online math platform that is used as part of the school curriculum. And so here we have a platform used by about 800,000 students. And importantly, it was integrated into their curriculum even before COVID hit. And we track their progress forward once the coronavirus hits, both whether you're in a low income or high income school district, everyone's progress drops, although quite a lot more if you're in a low income school district. However, by the end of the spring semester, progress in maths had recovered in top income schools, whereas remained low in the bottom income schools. And looking forward, we see this gap has persisted, although it's shrunk considerably as schools have managed to prepare for the fall semester. And so that's something that we're really going to be tracking going forward, because I think this data really illustrates the potential that not only will the coronavirus increase inequality as benefits expire and household income starts to more closely resemble earned income, there's also a real potential that this will increase inequality into the next generation of workers whose educational experiences may differ quite dramatically depending on their resources right now during the pandemic. So I want to end there. I know that our first talk ended on a positive note, and here I end on a pessimistic note. Perhaps that's a good moment to return to Chryssi and turn to questions.
Thank you very much. This was great. I know we are a bit over time, but I didn't want to interrupt this very interesting presentation of information and data coming from the US. And I mean, usually the role of what I'm doing here would be to initiate some kind of debate and discussion among the three speakers. Unfortunately, for the wrong reasons, it's very difficult to create a debate with this topic, because I think everybody agrees that we are in a situation that is quite dire in terms of inequality and where we're going forward. So I don't think that any of the three speakers disagree with each other about where things are. Although some had positive endings, some of them had more negative, more pessimistic endings. So what I want to do is to ask a couple of questions to generate a little bit of discussion, to see your views, hear your views, while other members of the audience want to pose some maybe further questions in Slido. I wanted to ask a bit to go over, because we're from the two different sides of how we've been doing things. Can we compare the different policies that have been done in the UK versus the US? The furlough policy has been really big here, while in the US it hasn't been at all, almost. I mean, there has been some, but very low key. And with a view of thinking about how going forward, we expect these policies to have a long run impact. I mean, in my mind, I mean, hearing this and not being really a specialist in this area, I cannot help but wonder, did the furlough policy in the UK just freeze the labor market and say, let's postpone the problem until we run into it again? And what are we doing with this, with the labor market? Are we messing it up more? Is it partly the failure that Torsten was bringing up due to the fact that we're actually put things on hold and wait for the problem to come knocking on our door again? Or should we have done what happened in the US and let the labor market crash and have this huge unemployment spike? So I'm happy to hear your views and bounce ideas on this. Maybe Torsten want to start, since you can follow it up more.
It's a very big question. You almost so look, let's take that in chunks. So let's just directly do the US-UK comparison first, because the approaches taken are very different, but they're not as different as they appear in the headline data, I think is the important thing to say. So big picture, what does it look like? It looks like the UK has, in a kind of admittedly kind of slightly emergency fashion, introduced a European style furlough scheme at very short notice to take the strain off its social security system, because that system has very few earnings related elements to it. And so we couldn't cope with that lack of insurance given the degree of economic shutdown taking place. Although they have also increased the generosity of that the non-earnings related part of the social security system, whereas the US has accepted the fall in employment and increased the generosity of its unemployment insurance, but by a flat rate, not by an earnings related amount, because of one thing we've learned in both countries, by the way, is that IT constraints on delivering policy change in a crisis are very, very large. And people that ignored those in making their proposals were kind of talking to the wind. And that's a good lesson for everybody that cares about whether what they say has any policy impact at all. Right, so that's the big picture. Those are different approaches and different models. Therefore, it's not surprising that the UK unemployment rate has hardly budged until June, and the US unemployment rate immediately went through the roof. So that's the big picture. The reason they're not as distinct as they appear is because within the US, in a way that doesn't exist in the UK, the unemployment insurance system they basically are, a large chunk of those workers are pretty close to being furloughed in any normal sense, because there's an option to kind of return to it's like a two-way option where your employer and the employee can restart the relationship despite having taken the unemployment insurance I can't remember the time constraints. And so what you're seeing is huge unemployment increase in the US, almost none in the UK, despite the overall falls in GDP not being that dissimilar, which is now has worked. And then basically, as you put it, Chryssi, unfreeze the economy in the UK and the US, they're then converging as the people that look like that we would consider furloughed in the US unemployment insurance return to work. And in the UK, we unfreeze furlough, some of those people return to work, and some of them become unemployed. And so they're converging now. And that, I think, is true broadly as a way of thinking about the broader US versus European approach to this crisis. I think the distinctions come specifically in that the UK is now trying a actually properly continental style part-time working scheme. Like it's trying to emulate the German scheme, but it is doing it in a cat-handed way, so that it won't succeed in its objective, which is cutting hours rather than cutting jobs, which is the main benefit of the German scheme. Whereas the US is not trying that and is having instead a row about what level of replacement rates should we be providing to our workers. My last point then, lessons that I would draw, and I think we can clearly see from this crisis, are that the targeting, you've got to top in this kind of crisis where income insurance is the key objective in the lockdown phase, you've got to put money where it is actually needed. And there was a lot of proposals in the UK for sending everybody a check, and in the US there was an actual sending everybody a check policy.
And we just heard that it didn't really work very well.
It's a turkey of a policy, and it was obviously a turkey of a policy because we are shutting down some sectors. And so the idea that putting general spending power in the economy will funnel money to the places that are the people working in the places that are shut down is a really stupid idea. And despite that, it has been all over the place. So like understanding the nature of the crisis rather than what you've always wanted to be the policy answer should definitely be a key lesson from the crisis.
And I should add maybe to that, maybe Michael can tell us more about this, that I think we have past experience from similar schemes, very different targeting of where money was just sent blanketly to, I mean, Raj Shetty has been working on this for years, and we know that these kind of policies are not particularly useful for the target that they're aiming at. So maybe I pass on, I mean, Xiaowei, you were shaking your head before.
I'd be keen to come in on some of those points as well, but yeah, happy to do so after Michael.
Michael.
Shall I comment a bit on Torsten's point. No, go ahead, sorry.
I'll add, I thought Torsten covered the topic brilliantly. I'll just add 2 points. One is that I think basically the progression of the virus and the emergence of a strong second wave has made the US and the UK policies more similar than we might have anticipated ex ante. There was a real ambition that it was possible to freeze the economy using a furlough policy and then unfreeze it. And the idea there was that there are these productive employer-employee matches that we didn't want to break. We didn't want any interruption, so that it would be as frictionless as possible to return to where we were in February. And because COVID has unfolded for so long and the economy has had to contract for such a long period, that ambition is sort of not played out as people had hoped. And so I think what you're seeing is that the policy where in many ways, it was just a nominal difference, as Torsten was indicating, whether people are formally attached or formally detached from their employer, tends to matter less and less as the amount of time in which the economy has contracted gets prolonged. The last thought is that I completely agree on the importance of targeting the benefits. And I think we see that very clearly in the US data, where sending money to high income people that provides little benefit to, it doesn't flow through to the businesses that are struggling. It doesn't stimulate the economy. And so really what we need is traditional social insurance. And I think if we just want to think more broadly outside of this crisis, I think this plays into this debate around a basic income, where many of the proponents of a basic income are, I think, have not fully engaged with the literature around the current social insurance system and how it is targeted, and how providing a floor to everyone, regardless of any targeting, makes it more difficult to target, say, disability benefits, benefits to families with children. It just becomes, if we tie our hands on how we target benefits, it becomes harder to provide the benefits to the people who need the most social insurance. And we see that in this crisis, but it's potentially a more general implication.
Thank you. Xiaowei, would you like to comment a bit on all this?
Yeah, sure. So first of all, yeah, absolutely agree with both Torsten and Michael in terms of the difference between the UK and US policy responses being smaller than they actually seem. One nice bit of data I saw on this actually was looking at US workers' expectations of being recalled after they were made unemployed. And actually starting out at the point of unemployment, 90% of people expected to be recalled to their original jobs. Now it's still about 70%. So actually looking at that, it's not very different from the furlough scheme we have here. The point I perhaps disagree with Torsten on is that that point you made about the UK scheme sort of trying to emulate short-term work schemes in continental Europe and sort of failing short. I think maybe it's not so much of a policy flaw, but a difference in emphasis between these two schemes. Because as Michael said, I mean, it's part of the point of things like the furlough scheme is to freeze the economy as it was, so we don't have to go through this period of very inefficient adjustment just to go back to where we were, right? We don't have to lay people off and rehire them, have businesses fail, have businesses restart just to go back to where we were. But of course, the flip side of that is that we're also trying to avoid propping up jobs that won't really come back into the future. And I think the longer the pandemic drags on, the more important that becomes, because the more clear it is that there will be longer term shifts to people's preferences, people's behaviors that may well persist into the future. So whilst I think that people will go back to going to the theatre, the art scene will revive when the pandemic ends, we might still carry on working from home now and then. We might not go back to an economy where, you know, you can sustain a Pret on every block in the centre of London. So I think what the UK government has done is just made it quite a different trade-off between preserving employee-employee matches and allowing this sort of labour readjustment to take place. I think in part that's perhaps a political judgment, a value judgment on the sort of value of these employer-employee matches. I think to some extent it also does reflect the different industrial mix in the UK compared to, say, places like Germany. So in Germany, you've got a huge manufacturing sector where, you know, there's really high value to job-specific skills that would be lost if people separated from their original employment contract. In the UK, if you look at the sectors that have been hit, things like hospitality, retail, turnover is incredibly high anyway, so perhaps there's less value in protecting those matches. Now, of course, there's a separate argument about protecting incomes, right, which is, I think, quite separate from protecting employee-employer matches. And in the UK at the moment, we've sort of combined these two things into one in terms of the furlough scheme. As you said, UC is nowhere near as generous as the furlough scheme. So we've been doing both these things through one scheme. I think in principle, there's no reason we have to protect incomes through the furlough scheme, right? And that goes to your point about ramping up UC in expectation of more job losses going forward.
Thank you so much. I know we have not that much time to cover questions, but I will just throw one more because I have maybe a bit of personal interest in addressing this. This is mostly for Xiaowei because she did address more inequalities that come from demographic perspectives of COVID. Women have been hit hard. I think, there's not a single paper working on COVID these days not talking about the fact that the working women have been hit really hard with this pandemic. And I wanted to ask, starting with you, if you want, there is a kind of a recent literature that is macroeconomic and economic growth suggesting that part of a lot of the recent growth that economies have been experiencing came from allowing certain demographic groups to break the barriers and break the glass ceilings and move into the labor markets and show their talents, right? Like women, Black population, ethnic minorities, and so on, that we didn't have 50, 60 years ago. And my worry, as perhaps maybe as a working woman as well as a person that is a professional, is the damage that we have been getting in the last few months. Will it take us back where at that stage that, we're losing skill, we're getting out of work, a lot of women are giving up working directly or indirectly sometimes, maybe even they look as if they're working on the record, but they're really looking after their children or cooking at home. And I want you to kind of give a thought or a comment on where you think this is taking us in the long run, if we're going to have severe long run impact from this or not, or what can we do to alleviate it? Thank you.
Yeah, all interesting points. I think it really depends on whether you think the effects so far are permanent or just a transitory reflection of the fact that schools have been shut down during lockdown, right? And it's primarily the mother who's been giving care to their kids. One thing I might just note in case someone picks up on this, catches me out, is that actually if you look at just the differences between men and women in general, it actually seems that men have suffered more in terms of the economic impact. So men are more likely to be furloughed and men are also more likely to have been laid off. The difference, as you say, is when we start looking at mothers and fathers, and it's disproportionately mothers who've borne the brunt of the childcare during lockdown, and they're the ones who've been furloughed probably a lot of the time voluntarily and reduced their working hours. So I guess the real question going forward is then whether this is just a very temporary spell of disruption in their work that's just going to be fine now that kids are back in school, or whether we expect it to have sort of longer term consequences. Personally, to be honest, I think I'm quite optimistic on this front. It seems like schools are not about to close again. It was still a relatively time limited period that women missed out on, progressing their careers. And I do think that if there is a wider shift to remote working, that might have benefits for women as well in terms of their ability to stay on in the labour market. But perhaps I'm just being too optimistic here.
It's good to be optimistic. I think we need to be optimistic these days. Torsten and Mike,
I'd say,
comment, yeah?
Perhaps a note of more mixed optimism. In the US and in Canada, we see large numbers of women exiting the labor force in September as the school year. It seems like they were holding on to their jobs through the spring in expectation that things would be better in the fall. And with intense second waves happening in the fall, you see it's very distressing to see the number of women exiting the labor force. And it's a completely different picture just in the last couple months than for men.
Sorry to interrupt just a second. Can I confirm with you that I know correctly that indeed some schools in some states in the US are closed again, right?
Yes.
Yeah.
Yes. And you have hybrid models of teaching where in many places where students are in school 2 days of the week and at home 3 days of the week. I have mixed. So one question, I completely agree with Xiaowei that the question is this a transitory change or a permanent change? Both in, obviously, school closings are transitory. Is the loss of human capital transitory or permanent? Are people who are out of work for 6 months or a year going to be welcomed back to the labor force at the same wage? And have men just progressed in their career while women have lost the opportunity for progression? And I think I also have concerns. I think an increased move toward working from home is a double-edged sword for women in the workforce, because often what we see is that, say, in households where men and women earn the same amount and have the same level of earning responsibility, women often predominantly take on the caregiving responsibility. And so you might have a growing sense that women are expected to work from home and work in the home simultaneously. And that could actually be exacerbated if they're at home during the day. I think my note of optimism is that there is a potential for sort of a democratic grassroots response to these changes. And I see this in Canada with growing conversations around the need for a national childcare program, a national elder care program, where these are areas that have been traditionally underfunded, according to many people, and the value of childcare and the value of elder care has really been spotlighted in this crisis. And so I'm sort of pessimistic in the short term, but I think long term, there's the optimism that people will demand greater services that could actually facilitate women's work and women's equality moving forward.
Thank you. Torsten, any further comments?
Yeah, so overall, I think one of the surprises of this crisis, actually going back to what Xiaowei says, is that given the sectors being hardest hit and the low earners point we made, consistently, actually, I expected to see the job losses being more focused on women than they actually have been. In reality, it has not been as female focused as some, as I feared, and as lots of people actually, I think, still keep saying it has been. I think in practice that isn't true. I think the reason that isn't true is, one, because female low earners are much more likely to be public sector workers than the male low earners, and they've been protected by the crisis. And secondly, that male self-employment has taken an absolute hammering during the crisis. In practice is what is happening. I think we should definitely be worried about the labour. For the second point, the fact that it's evenly-ish between the genders, though, is very unusual from previous crises. So historically, men see much bigger unemployment falls than women. And so this one is unusual that they're even close to each other. Okay, so it's still worse for women relative to previous crises. The third point is that if I was thinking about where does my labour supply worries come in the UK, in the US is like a disaster for childcare provision. It's been a disaster for reopening schools in some of these places. It's a disaster for women. The fact that they've managed to take female labour force participation backwards over what is the 21st century about? Getting basically close to 50-50 on labour force participation. Only like the US and Turkey have managed to go backwards on it. Okay, that's because they have a disastrous welfare state and lots of other reasons. So I think park the US as a basket case. For the UK, I'm much more worried about the labour supply effect on young workers and on near retirement workers. That is where we're going to see permanent loss of economic activity that will mean slower growth for the next few years. And that's where policy in the UK should be focused. On women, stepping back, all of the growth in employment post the financial crisis, all was by women in the UK, all of it. And the reason it was being driven by women is because household incomes were being hammered because of the wage stagnation. And the way households have responded to that is by supplying more labour. And so second earners and older women have gone back into the labour force or stayed in the labour force to keep their household incomes up in the face of a disaster. And that disaster is carrying on. So the labour supply, I'm afraid, is going to stay high because the driver of it is low incomes.
Thank you so much. I think we can leave a few minutes now for questions, and I will pass on to Laura for this. Thank you.
Yeah, so very interesting talk. We had quite some questions and some also exchange of opinions. So I think that there is kind of agreement that we need somehow some public policies. But there has been a nice exchange of opinions about how should we fund these policies. So should we fund them with higher debt, which means higher future taxes, or given that we know that some sectors or some parts of the wealth distribution are not affected by the crisis, so increase the taxes for these parts of the wealth distribution today. So which is your view?
Do you want
So,
go?
Yeah.
Michael, you go first. Go.
okay. So thinking about the role of government, if there was ever a time for governments to provide smoothing over time, now is the right time, right? We are struck with a short-term, absolutely massive fiscal crisis, and that is a time to borrow money. And the idea that we should try to fund all of this sort of in the short term by increasing taxes on the businesses that are suffering relatively less strikes me as short-sighted. In particular, say in some of the examples I was showing, even financial services and professional services sector businesses had 20% declines in revenues in the United States. And so, yeah, they're doing well relative to the other businesses, but they're still struggling. So it seems like precisely the classic situation where you would want the government to step in and say, we are uniquely able to smooth pain into future generations, and we're going to spend and stimulate the economy now, and we're going to smoothly draw down this debt that we accrue through future adjustments in taxes and spending. That would be my view.
I think we're all going to agree on that because it's at one level blindingly obvious that we should be insuring people against the disaster. You can't insure people against a pandemic, it turns out, and so not surprisingly, that's the state's job. I think so let's just try and focus on one there might be bits of disagreement. In terms of how we actually pay for that debt, I don't think taxes on those that have done well have a large part to play, although I think that's for two reasons. One, because they won't raise that much revenue for the reasons Michael's raising, that there aren't that many of them that have done very well. But and secondly, because remember that we're not living in a world where we can set our fiscal policy separately from our need to deliver macroeconomic stabilization, because we have no role for zero. Interest rates can't carry any of the burden really of our stabilization during this phase. So the most important thing for fiscal policy is not to mess up its impact on the macroeconomics, as well as getting these micro bits right. But so just to make sure we have some disagreement, my view is there are elements where people have done very well. And as fact one. Fact two, lots of big tax rises are coming down the track to pay for some of this. And I think for reasons of political economy and for public buy-in, I am in favor of being careful about making sure we claw back some of the windfall gained during this crisis, because my lesson from someone who was in the Treasury post-financial crisis is that we didn't take issues like that sufficiently seriously, and it caused big public consent problems. So specifically, the way we've done our self-employment support in the UK has been an absolute disaster in terms of matching need. Loads of people who've lost huge amounts of income have got nothing, and lots of people who have had no fall in their income whatsoever have had very large government grants. We should be clawing more of that back than we are going to. And if we don't, given this crisis is going to go on, we're going to have serious consent challenges. And then for the small number of companies that have seen large increases in profit levels. So increases, not just smaller falls, actual increases during the pandemic. I'm not averse to small surcharges that say, if you happen to provide PPE equipment and you contributed during this element, that is great. But, you know, just like we're insuring people because they couldn't insure themselves against the losses from a pandemic, the idea that you should get massive windfall from having to invest in the one PPE factory in the UK, I think that's a bit odd. So and unfortunately, my trustee meeting is just starting. So I'm unfortunately going to have to drop off so I can, keep the charity functioning during this time. Thank you for a very nice chat.
Thank you very much, Torsten. Yeah,
Thank you, Torsten.
Yeah, so just to pick up on what Torsten said, yeah, absolutely agree with both Michael and Torsten. Now is not the time to start raising taxes, if only because you don't want a fall in aggregate demand to like unravel through the economy even further. Agree with Torsten that we should really be thinking about which taxes we raise in the future and how we recoup some of how we pay down the debt. Not totally sure about windfall taxes, but haven't thought about that so deeply. I guess one potential problem is that we know that tech companies like Amazon have done very well out of the crisis, and they're notoriously hard to tax. So politically, what would it mean if we're not taxing Amazon, but we're taxing some PPE provider for the gains they've made during the crisis? I think one element of inequality that's really important to bear in mind is the intergenerational inequality that we've seen. So the health impacts have been, well, the physical health impacts have been small in young people, but we know that the mental health impacts have been large, and the economic impacts will be very, very large indeed. So it's important not to just look at income taxes going forward in terms of paying down the debt, because it will be the young generations today who will be paying back that income tax in the future. But maybe now is a good time to be looking at wealth taxes that will hit other parts of the population.
Great.
On that note, I think one interest, perhaps we want to wrap up.
No, go ahead. Yeah.
I without taking a position on the wisdom of this tax, I think one interesting debate that I've seen is around the notion of a one-time wealth tax.
Yeah.
Because in economic theory, the real cost of something like a wealth tax or a capital tax is the wedge it creates in the value of investing and wealth creation. And one-time taxes are incredibly efficient. The problem is, can you credibly say this is a one-time thing? And if you can't credibly say it, you can't convince people of that, well, then it's no better than a recurring tax. I think there is plausibly good rationale here for this is a one-time thing that we are going to address with a one-time tax. And that could have the potential to be an economically efficient way of raising revenue that also addresses some, is specifically targeted at some of the people who have the wealth on hand and could sort of contribute to the economic recovery. I think there's an interesting political economy debate about whether that is something that the public would support, but from an I think economists should be contributing to that debate because it is an interesting policy idea.
Yeah, thanks very much. I think, Chryssi, maybe we need to wrap up actually, right? Thank you very much. Very interesting talks.
Thank you so much, everybody, for those that stayed behind for the questions. I think I'm expected to say something about tomorrow's session. To remind you that if you want to sign in and see tomorrow's session, it will be on monetary policy implications. The speakers for tomorrow are Charlie Bean, Loretta Mess, and Christine Forbes, again at 3 p.m. And thank you once again for joining us today on a wonderful session on the inequalities of COVID.